Hello, everybody. It's time for us to have our half hour together on Monday mornings. This has become a regular routine. I hope it has for you. I enjoy it. I enjoy sharing our thoughts with you at the beginning of the week and wishing you a successful week up ahead here. But we'll get to that at the end of the program here. Max has decided to join us today. He's snoozing over there. So if you hear a little snoring, you'll know where that's coming from. He always enjoys these calls. It puts him to sleep, and he feels very comfortable. We've had some beautiful weather here over the weekend. It started out hot, like in a lot of other parts of the country, on Saturday, but Sunday it was almost like September. So we really had a good day then, and we seem to be having a nice day. Today, July 31st, the end of July. How time flies when you're having as much fun as we are, right? Tomorrow will be August 1st, and before you know it, it'll be September, and so on and so forth. I don't know about you, but my wife and I keep talking about how this is the fastest year we've ever seen whizzing by. Can't quite explain why that's the case, but maybe it's that's the most obvious explanation. As we all get older, it seems as though time flies faster than in the past. But speaking of time flying, this bull market has really had it hasn't been flying, but it has been flying. It's been awesome since October 12th of last year. Last I heard, it's up something like 19% so far this year. And of course, the NASDAQ is up a heck of a lot more. And yet, despite all the excitement, there's still a lot of nervousness out there that the market is, its breadth is narrow, and that not enough. Oh, that's Oscar, by the way. That's my mother-in-law's dog. So we'll see whether he wants to participate. So there's been a lot of concerns that the market breadth is narrow, that it's only been 7-8 stocks that have led the way, that we're seeing the bears capitulate, which from a contrarian perspective is bearish. And then, of course, sentiment has been very upbeat. We've seen the AAII sentiment index quite elevated, with a lot more bulls and bears, and we've seen the investors' intelligence bull-bear ratio up to 3.0. And so the technicians are pointing out that there's a lot of vulnerabilities in the market. We've been arguing that, yeah, the market's narrow, but it doesn't mean it couldn't broaden out. Small mid-cap stocks are extremely cheap. Everybody keeps looking at the valuation multiples of the S&P 500. It's 19.5. But that's the mega cap 8. You take out the mega cap 8, you've got 16.5, which is a little bit better than the historical average of 15. So it's fair. It's fairly valued, excluding the mega cap 8. And the mega cap 8 seem to have a life of their own. They're now about 28% of the S&P 500, and that's a fact of life that we have to deal with. It is what it is, and it certainly explains why we have such a high valuation multiple on the S&P 500. Take out the 8, just look at the 492, S&P 492, and it's a more reasonably priced market. And now it seems as though it may very well be broadening out. Let's look at a quick takes that we posted a few days ago. Let's see if I can find it. There it is, I think. And so this is the quick takes we did on July 30th. And as you can see, there's lots of charts that say that the market's overextended, it's overbought, needs to correct. This is one of them, shows the S&P 500 as a percent of the 200-day moving average. And as you can see, that's looking quite extended. It's been up here before and stayed here for a while, but you know, there's a cycle to this thing, and it may very well correct. If it does come back to its 200-day moving average, like effective today, you'd be down to like 4,000 on the S&P 500. So that would be quite a move to the downside. And of course, the technicians are worrying about that. And the bears, there's still bears out there who think that we haven't seen the end of the bear market. I pointed out in this quick takes that the Dow Jones Transportation Average, obviously a component of the Dow theory, has suddenly picked up here, and it's only a couple of percentage points away from going into record high territory. I think that's pretty impressive. And the improvement has been pretty much across the board in the components of the transportation average, but we're seeing some signs of life in the railroad industry. The railroad industry has been hard hit by the rolling recession in the goods sector. There are just fewer goods coming in from overseas through the ports to transport to retailers. But if that goods recession if that rolling recession in goods is starting to bottom out, which there's some evidence of that being the case, and we start to see some improvement there, that would certainly help the rails. And the market seems to be anticipating that if we're not going to have a recession, then we're going to have an expansion. And if we're going to have an expansion, that means the consumer continues to spend, and maybe we'll spend not just on focusing on services, but increasingly we'll come back to goods. I mean, for all the talk about the goods recession, the reality is consumption of goods in inflation-adjusted terms has been flat since middle of 2021, but it's been flat at an all-time record high. So it's still well above where it was pre-pandemic. So they're maintaining a high level of consumption. It's just not growing. And the growth that we're seeing in incomes, purchasing power, has been going to services. So that's why we haven't had an economy-wide recession. So here we looked at some of the components. The rails have been the laggards in the on a year-to-date basis. Rail transportation, the leading has been cargo ground transportation, passenger airlines 25.3%, and the air freight and logistics should benefit from a global economy that's slowed down but not falling into recession, and a U.S. economy that may very well be going from a rolling recession to a rolling recovery, and so that's up at 19.3%. Well, let's go to the charts for the morning briefing. And in the morning briefing, we once again addressed our debate over the past year and a half with the bears. So it's been an interesting debate, bears versus bulls. We're staying very much informed about what the bears are thinking, and at some point they may get it right and we may agree with them, but at this point we instead are in a debate, and we're on they're the honorable opposition, and we're presenting some counterpoints to the arguments they've been making. One of the concerns that the bears have had, and I think some of them continue to be concerned about, is the leading economic indicators. And we have for quite some time been arguing that the LEI might be somewhat biased towards the goods side of the economy. And the goods side is in a recession. It's a rolling recession. As I said, we went on a buying binge in 2020-21. When I say we, I mean my family, but we weren't alone. And so everybody went on a goods buying binge, and they couldn't buy services. But by late 2021, we started to see the goods buying binge slow down, maintained at a record level, but slow down. And we started to see that as the service economy opened up and people felt more comfortable about going to restaurants and traveling and going to sports events and entertainment and all that, they started pivoting in that direction. So the goods sector, as you can see, is demonstrated here with the manufacturing PMI, and the relationship between the manufacturing PMI and the year-over-year percent change in LEI is awfully tight. Again, supporting our view that the LEI may be missing, not maybe, but is missing services because it's giving too much weight to goods. Another concern, of course, has been the inverted yield curve. We've said many times, we've shared with you our thoughts that we actually first wrote up in 2019 in a tiny book called The Yield Curve, What Is It Really Predicting? And the conclusion was that the yield curve isn't predicting recessions, it's predicting a process that leads to recessions. It predicts that when bond investors are willing to buy a 10-year at a yield below the 2-year, they're basically saying that there's no point in holding on to 2-year and thinking that we can roll it over into higher rates than we're getting in the 10-year, that within the next 2 years, the 2-year may very well be below the 10-year. And that reflects a perception that if the Fed continues to tighten, there might be a financial crisis. And as you can see in figure 2, sure enough, every time you've had inverted yield curves, there's been something that blew up in the financial system. And that in turn led to an economy-wide credit crunch where even good borrowers couldn't borrow, which then led to a recession. I haven't seen the SLOOS, the Senior Loan Officers survey yet. Look for it, but I already know what's in it. Last Wednesday, Fed Chairman Jerome Powell gave us a insight into the SLOOS. He said that it's going to show that credit conditions have continued to tighten considerably. And the good news is that if he knows that and he's stressing it in the press conference, then he's basically saying that maybe, just maybe, the Fed has raised the Fed funds rate and along with QT in a fashion that's awfully restrictive. And now we're starting to see the long and variable lag effect that's having on bank lending. And so that might be enough to dissuade the Fed from continuing to raise interest rates. But the fact of the matter is the inverted yield curve did an excellent job of anticipating that something would blow up. In this case, as you can see, we've put in the SVB blow up, this Silicon Valley Bank. That was in March 9th and 10th of this year. And then on March 12th, on a Sunday, the Fed came in with a liquidity facility and basically succeeded in containing the financial crisis, so it hasn't become an economy-wide credit crunch or an economy-wide recession. Meanwhile, in deference and respect to the bears, we're monitoring what they're saying, and we're monitoring the data that may or may not support what they're saying. And so they clearly are concerned about a credit crunch, economy-wide credit crunch. It ain't over until it's over. And so we're watching the weekly data that the Fed puts out on deposits, loans, leases, securities, borrowings. The deposits have been coming down. That's partly because of quantitative tightening. But the reality is deposits look like they're actually starting to flatten out. Maybe they're kind of finally caught up with this pre-pandemic trend. So that doesn't look so bad. But yet deposits are down. So isn't that creating a credit crunch? And it doesn't look like it's a run on deposits. For a couple of days there in March, it looked like we could have that, but the Fed stabilized the situation. But you can see that securities are falling. I think the securities are falling because they're maturing and the banks aren't rolling them over, and they're using the proceeds to offset the weakness in deposits, which allows them to maintain their loans at a record level. Maybe with a magnifying glass, we can see that the loans are starting to flatten out, which is sort of a mini credit crunch if they're not adding to loans. But let's look at the loans. Meanwhile, borrowings also kind of came in handy here during the banking crisis, and now it's edged down. Let's look at the loans weekly through July 19th. So we're well past the banking crisis, and you can see, we got a problem here, right? Commercial and industrial loans are down, but that could be inventory, the inventory situation. A lot of companies got stuck, retailers, manufacturers, wholesalers got stuck with inventories that consumers didn't want to buy, and they had to discount them. And maybe they're finally clearing the decks of those inventories, and that's why we're seeing the C&I loans go down. Of course, it's possible that the banks are just becoming a lot tougher in lending, but I would attribute this mostly to sort of the cycle in inventories. Then this blue line is residential real estate. Doesn't really matter much. The banks don't do all that much in residential real estate. A lot of that's done by Fannie and Freddie, and I guess they're keeping some of the better loans, better yielding loans on their books. And then we've got, what else do we have? Commercial real estate, that's always fun. Commercial real estate actually went to a new record high in the latest week. So we're not seeing that rolling over, but anecdotally, we know that there's problems in the commercial real estate market. There's no doubt about that. Consumer loans, all-time record high. So there's no credit crunch so far. And the loans admittedly are a lagging indicator, as you can see from previous experiences, well, particularly here, they tend to be laggards. So it's still, the bears could still be right. There could still be a credit crunch, but that's not our story. So we'll see what the sleuth comes up with. This is through the second quarter. Haven't seen the, let me see here. We could real quickly here, see if this thing got updated. So we're looking for, well, that says May 9th. Let's refresh it. Oh, bingo. Okay, well, I'm looking at it at the same time as you are first time. This, well, but it didn't get updated. It's got a new date, but it's still Q2 data. I'm not saying Q3. All right, never mind. Well, let me see something here. Yeah, that I know Q3, it's hard to think about Q3, but July is a Q3 data series. So never mind. We got the right date on the thing, but it hasn't been updated. So we'll worry about that later. But again, we know from Fed Chair Powell's presser that it got credit conditions got tighter. Well, how about M2? M2 has been falling along with those deposits that we looked at. It's down by about 4%. You know, you go back to the data going 59. I mean, this is looks terrible. You didn't have this before during some pretty nasty recessions, but it's all the year-over-year comparisons. I mean, this was up 26%, and by our estimate, M2 is still about $1 trillion above its pre-pandemic trend line. There certainly seems to be still a lot of liquidity there from the past few years that is offsetting some of the Fed's tightening. Look at this, all commercial bank total deposits plus money market mutual funds. And these are, you know, this is basically M2, but it's on a weekly basis. And you can see that we're around, we're $23 trillion in this very liquid category of assets. And we're still up quite significantly from where we were back here. So there's probably still a lot of liquidity preference, risk aversion being causing people to keep a lot of money in liquid assets. Also, they're getting a better return. And so they figure, you know, why play in the bond market? Why play in the stock market? Let's keep it in this kind of asset. But of course, as they see the stock market going up, some of them are going to conclude, well, maybe they want to be back in the market with some of this money. So there is liquidity. And the fact that the bond market's held up so well in the face of relatively strong economic data. Granted, inflation's come down, but it still hasn't come down to 2%. And the Fed keeps talking hawkishly about maybe moving further. Yet, despite all that, the bond market's held up quite well, just around 4% without going to 5-6%, which some people were arguing a year or two ago to me. Well, what are the bears missing? What are the pessimists missing? What are the hardlanders missing? They're missing a lot. They don't seem to be giving much weight to onshoring. And you can see this is the latest real GDP data. And there's a component in there for structures and manufacturing structures. Spending is up 54% on a year-over-year basis. That's pretty impressive. All-time record high, and it's probably going to continue to move higher. Onshoring and the fiscal incentives to continue to onshore, especially things like battery, auto batteries, lithium batteries, semiconductors, and so on. Here's another interesting one. Well, if we're building more manufacturing facilities, we need more construction equipment, and that's not at an all-time record high, but it's continued to move up to relatively high levels. So that's a big positive for Cat and Deere and some of these other construction equipment companies. Then the naysayers have been saying that the stock market is a speculative bubble driven by the AI craziness, the AI hype. I think there's a certain truth to that, clearly. But on the other hand, when you look at the latest real GDP numbers and look at spending on software, it's at an all-time record high. Forget what the increase is. I think it's like a double-digit increase. There's only a 1% increase in research and development, but that's the green line, but that's also at a record high. And we know there's a lot of R&D going on related to artificial intelligence, nanotechnology, and quantum computing. So that's an important source of economic growth. So I think that counters the idea that it's all hype. I mean, the reality is companies really are spending more inflation adjusted on real spending on software, real spending on research and development. And we also watch the information processing, still on an uptrend line, given that Intel's saying that the PC recession might be over. Maybe we're going to start to see that information processing equipment goes up. And we know that data centers are expanding quite rapidly. There's actually a REIT in data centers, and that's held up pretty well. Looks like it's picking up. And so the data centers need all that equipment. Here's another thing, new orders, non-defense aircraft and parts. We know that people are traveling a lot around the world. And so the civilian aircraft makers, Boeing and GE and so on, they're starting to see some real pickup in their the demand for what they produce, which is these tubes that have a couple of engines attached to them on wings that take us to everywhere we want to go. I shared with you that my wife and I went to Dubrovnik for a vacation, working vacation. Managed to do some work along the way, but we went to a few months in June. We went to Zagreb and Split and Dubrovnik, and I'm starting to think that we're dangerous because I think it was about a year ago in May that we went to Yellowstone, and 1 week later the park was completely flooded. Roads were damaged. They had to close the park, so we dodged that bullet. And now here in Dubrovnik in Croatia, we went in June, and then several weeks later, they've got fires right where we were there in Dubrovnik. So in case you're interested, next place we're gonna go is Scandinavia. That's gonna be in September, so watch out. Go in early September if you're gonna go, because after that, we could be a jinx here, and there could be some problems there, but I don't know, things always seem to go quite nicely in Scandinavia. Back to our story here. Figure 12, what else are the naysayers missing? Why have they not been getting the recession? Well, in addition to onshoring, capital spending being strong, software spending being strong, the government spending more money. In GDP, you don't get all aspects of government spending. You get spending on goods and services adjusted for inflation. And it edged up here to an all-time record high, and likely will continue to go up as infrastructure spending increases. Of course, some of that is going to be done by state and local governments, so we'll be watching that. That's federal, that's state and local governments. And then the federal government, the fiscal policy is offsetting the tightening of monetary policy. And as you can see, the deficit has ballooned from something like $1 trillion a few months ago on a 12-month basis to $2.3 trillion. Tax receipts have come down, and you know, all those all those emergency payments made by the government for the pandemic relief, we had to pay taxes on that, so it came back to as tax revenues, and now that's all over. And so now we're seeing what the true deficit is doing, and it's not pretty. And it is a source of stimulus for the economy. And so far, it hasn't clobbered the bond market, interestingly, even with QT going on. The federal government's interest payments, all-time record high, $600 billion. Well, how can we possibly put a positive spin on that? And the answer is, well, a good chunk of that's going into personal income, as in personal income received as interest payments. So that's actually been somewhat stimulative. So there's a stimulative aspect to that. Meanwhile, I'm not sure that, you know, once consumers have spent all their excess savings. I'm not convinced that personal savings is going to jump right back up to where it was before the pandemic. The pessimists say that we're going to run out of excess savings. Personal savings is going to go up to $1.5 trillion. And so consumers are going to be cutting back on consumption. I have been pointing out that there's a tremendous record amount of net worth in the household sector, $147 trillion in net worth. And about half of that is held by baby boomers who are retiring. And what do they save all that money for? Well, to retire, to spend money. So they're not going to be increasing their savings rate. So there's a tremendous cohort of the demographics that isn't going to be saving anymore. It's going to be dissaving, going to be eating their, going into their nest eggs. And maybe their kids are going to conclude, well, mom and dad are going to leave something for us. And so maybe we don't have to save that much. Something to think about. Meanwhile, the labor market remains strong, militating against a recession. And what does the latest data show? Well, the initial claims have been kind of crawling up here, but remain relatively low. Maybe they go straight up here the way they have in the past. I don't think so. And meanwhile, they're consistent with the unemployment rate still remaining awfully low. And that's corroborated by the jobs hard to get series in the consumer confidence survey. And you can see that actually downticked in July and consistent with the unemployment rate, maybe remaining around 3.6% when we get the data on Friday. We know that jobs openings remain very plentiful because the Conference Board survey has a series on jobs plentiful. It's available through July. The job openings is only available through May. Tomorrow, we're going to get the data through June, which is, again, it's a laggard. Meanwhile, we know from this data that there's a good chance the job openings remain plentiful, not just in June, but also in July. So again, it's hard to imagine that we're going to have a surprisingly bad employment report. So consumers, in addition to excess savings, have the good old-fashioned source of purchasing power, real private wages and salaries. We look at the earned income proxy every month, which is a proxy for personal incomes, real private wages and salaries, and that continues to move higher. And we are seeing that inflation-adjusted wages are, which had been flat during the pandemic, are now starting to crawl back up along the 1.2% trend they've been on for quite some time. Let me wet my whistle here. So that's an encouraging development for real purchasing power. What about retail sales? Well, they've been flat. And again, we've made the point that we're in a rolling recession. We haven't been saying that there's no recession. We've been saying it's a rolling recession. Housing, goods, now commercial real estate. But all in all, whatever weakness we've seen in retail sales here, adjusted for, well, this is nominal retail sales, so adjusted for inflation, it's also weak. But the service economy has been offsetting that. So that's my long-winded story. Let me take a couple of questions here. So far, I see one. I'll welcome a few more, though we don't have much time to stay within our 30-minute or 33-minute, I think I averaged 33 minutes. The reverse repo program has been trending down in recent weeks. How do you see this impacting market liquidity and credit crunch risk? Well, I think that just demonstrates that the banks do have some lending to do, but I think a lot of that may have to do with the QT program. So I don't think that really changes anything at all. I've never personally observed that the repo market has much impact on the kind of the macro outlook that we're dealing with. Okay, impact of student loan payments restarting. Well, that's another debating point in the debate between the bulls and the bears, between the hardlanders and softlanders. I guess I'm kind of morphing into a no-lander. I mean, I've been with the soft landing camp here for quite some time, starting last year. And now looking into the end of next year, we're kind of no-landers. As a matter of fact, I should have mentioned that we went from 75% soft landing 25% hard landing to 85% soft landing or no landing. And that leaves us with 15% for the hard landing. And since we've turned more optimistic, we're going to do even more work on trying to figure out what could go wrong with that. I'm perfectly willing to increase my odds of a hard landing if the data points in that direction and it kind of adds up in that direction. But so far, our thesis has worked out pretty well, but that doesn't mean that things can't go awry. Student loans, well, let's put it as a debating point for the hardlanders, but I don't think it's going to really depress consumer spending meaningfully. It's on the margin, it's going to have a negative impact, but I think it'll be more than enough positive impacts. Let's see, Hans says, hi, where I live, food inflation is getting a concern for many, I am sure, but consumers are still optimistic. Not sure where you live, Hans, but on a year-over-year basis, here in the US, the CPI food inflation rate has come down quite dramatically. Egg prices have plunged. We had like an avian flu situation there, and now there's eggs. I mean, some people are actually buying chickens to put in their backyards, but I haven't heard about that occurring anymore. So we are seeing food inflation coming down. Oh, Hans says Canada. But I guess I am concerned, like all of us should be concerned about what's going on in Ukraine. Damn thing just won't end. It's a horrible, horrible situation. The Russians obviously are the bad players in the situation, and now they've decided that they don't want to play nice with the grain deal. Quite the opposite. They want to cut off Ukraine from exporting grain, and that could have some serious impact on food inflation. But I think the most immediate horrible impact is on possible starvation in Africa and the Middle East, though Putin is promising that he's going to deliver some of his grains to that part of the world. But look, when it comes to commodity prices, we've all observed that just when we see prices going up and we get very pessimistic that there's a scarcity and the prices will never come down, guess what they do? They come down because demand eases and supply somehow or other expands. Okay, Vincenzo, those who, I'll make this the last question because we're running over time here. Let's see, those who forecast the inflation rise did so on the fact that money supply had skyrocketed. When M2 came back, they said inflation was on the way down, and then we would see somewhere at the end of 2023, early 2024, a recession. For instance, Professor Steve Hank, what do you think about the collapse of M2? I haven't been a monetary monetarist for quite some time. It's nice to see that there's still some monetarists around looking at M2. I pay attention to it, but I don't. It's really not part of my modeling. I will concede that M2 does have an impact on inflation, but I think even Milton Friedman toned things down when he said that while inflation is always and everywhere a monetary phenomenon, he kind of clarified that by saying persistent inflation. He said that there obviously could be supply shocks, and we think that the pandemic was to a large extent a shock. There was a supply shock, certainly on the good side. It was a supply shock on the housing side that's had impacts on rent, and we think that's dissipating. So I think the proof is in the relationship between M2 and inflation. Clearly, it's had some impact on it, but I think there's plenty of evidence that inflation, especially the recent experience, hasn't been just a monetary phenomenon, and that there's lots of other factors that are continuing to bring it down, which is kind of what we've been relying on. I'll take one more from Gus. I had thoughts on China and Europe, the impact on the US. Yeah, China's had a very weak recovery from its pandemic, lifting of its pandemic lockdowns. For many years, we've been arguing that China is evolving into the world's largest nursing home. Their demography is fundamentally deflationary. It's kind of like a large version of Japan. At least it's becoming that. And they've taken out a tremendous amount of debt over the years, and that doesn't seem to work anymore. They've got a property bubble. There's a lot of things going wrong there, and it's not clear that policy is going to be able to reverse that. I think the miracle is over. Remember, that was a while ago when we all concluded that the German growth miracle is over. Well, maybe the China growth miracle is over, and that's good for the rest of us, because we're seeing deflation in their PPI, and their PPI tends to have a tremendous impact on the PPI in the Eurozone and the United States. So it's contributing to bringing inflation down. Again, an example that while some people are looking at M2, when you look at things around the world, China is becoming an important source of deflation, which is disinflationary for us. Europe, their real GDP numbers came in better than expected. A lot of that was Ireland and France. Germany still looks like they're in a recession. But you put it all together, and you don't get a real boom in the global economy. You get a soft landing in the global economy. At least it's not as terrible as it was looking last summer, when people were worrying about the Europeans freezing in the dark and the Chinese being locked down and being kept from buying. So things aren't as bad as they looked last summer, but it still looks like a weak global economic growth environment, which is good for what the Fed's trying to accomplish here, which is to bring inflation down. And again, just another example that M2 is not the only source of inflation. I think that's enough. I've run my welcome here. Listen, have a great week. Hope the weather turns nicer for some of you in the South. Just don't send it our way if it continues to be tough, but all the best this week.